Hi everybody, and welcome to our first video in Chapter 18. Here we're going to be looking at accounting for income taxes. And we're going to be looking at describing the fundamentals of accounting for income taxes, looking at some additional issues in accounting for income taxes, explaining loss carryforwards, and lastly, describing the presentation of deferred income taxes in financial statements. And if we preview the chapter, we're going to be looking here at future taxable amounts and deferred taxes, future deductible amounts and deferred taxes, and a valuation allowance. And lastly, we're going to look at specific differences between GAAP and the tax code and some tax rate considerations. Here, we're going to be looking at accounting for net operating losses. We have a loss carry forward and we have a loss carry forward example. And then as we present this on the balance sheet, note disclosures, the income statement, and using the asset liability method. All right, let's get into the meat of the chapter. Here, corporations must file income tax returns following the guidelines developed by the IRS, the Internal Revenue Service, and because GAAP and tax regulations differ in a number of ways, the amounts reported for the following will be different. Income tax expense will be reported via GAAP. Income taxes payable will be reported via the Internal Revenue Code. So as we look at this with a little bit of animation here, our financial statements include exchanges, investors, and creditors, and we have pre-tax financial income and income tax expense. Here we're using GAAP. But for the tax return here, the IRS requires that we use the tax code, and that will develop our taxable income and our income taxes payable. Okay, let's look at an example here with Chelsea Incorporated. It reported revenues of $130,000 and expenses of $60,000 in each of its first 3 years of operations. For tax purposes, Chelsea reported the same expenses to the IRS in each of the years. Chelsea reported taxable revenues, however, of $100,000 in 2025, $150,000 in 2026, and $140,000 in 2027. What is the effect on the accounts of reporting differing amounts of revenue for GAAP versus tax? Well, here this slide summarizes the book and tax differences for 2025, 26, and 27. You can see our stable revenues and expenses for financial reporting income. Total of $210,000 and a total of $42,000 income tax expense. However, for tax reporting, because the revenues were different, taxable income is going to be different, and our income taxes payable are going to be different. However, over the 3 years, it's going to be the same taxable income as the pre-tax financial income would be. Okay, if we compare those differences then, income tax expense versus GAAP, we have a stable $14,000 a year for 2025, 2026, and 2027. For income taxes payable, however, we have an $8,000 income tax payable in 2025, $18,000 in 2026, and $6,000 for 2027. So our differences then would be less income taxes payable in 2025, but more income taxes payable in 2026 and 2027, completely offsetting in total for the 3-year period. Now, the differences between income tax expense and income taxes payable arise because, one, the companies use the full accrual method to report revenues. As a result, Chelsea's going to report pre-tax financial income of $70,000 and income tax expense of $14,000 for each of the 3 years. But for tax purposes, a cash basis is generally used to determine taxable income. For example, in 2025, taxable income is only $40,000, so Chelsea owes just $8,000 to the IRS that year. Chelsea classifies the income taxes payable as a current liability on its balance sheet. A temporary difference is the difference between the tax basis of an asset or liability and its reported carrying or book value in the GAAP-based financial statements that will result in taxable amounts or deductible amounts in future years. So, a taxable amount is going to increase taxable income in future years, and a deductible amount will decrease taxable income in future years. All right, so in Chelsea's situation, the only difference between book basis and tax basis of the assets and liabilities relates to accounts receivable that arose from revenue recognized for book purposes. Chelsea reports accounts receivable at $30,000 in the December 31, 2025 GAAP basis balance sheet. However, the receivables have a zero tax basis. So per the books, we have accounts receivable of $30,000, but per the tax return, we have zero at the end of 2025. So we assume here that 2025, we have that cumulative temporary difference here of $30,000. And then future taxable amounts will be in 2026 and 2027. So Chelsea assumes that it's going to collect accounts receivable and report the $30,000 collection as taxable revenues in future tax returns. Chelsea does this by recording what's called a deferred tax liability. A deferred tax liability represents the increase in taxes payable in future years as a result of taxable temporary differences existing at the end of the current year. So because it is the first year of operations for Chelsea, there is no deferred tax liability at the beginning of the year. So we're going to refer to the Chelsea example again, and we see that we have this temporary difference that exists at year end because Chelsea reports the revenue and related accounts receivable differently. The book basis is $30,000 and the tax basis is zero. So what is Chelsea's deferred tax liability at the end of 2025? And the total deferred tax liability at the end of 2025 is $6,000. We start with a book basis of accounts receivable, $30,000, and a tax basis of accounts receivable of zero. So we have a cumulative temporary difference at the end of 2025 of $30,000. And if we multiply that times the tax rate, we get our $6,000 deferred tax liability at the end of 2025. And so as we look at 2026 and 27, future years here, the tax rate then multiplied by those future years comes out $4,000 in 2026 and $2,000 in 2027, offsetting that $6,000 of 2025. Okay, so again, we'll refer back to the Chelsea example. And what is Chelsea's income tax expense in 2025? Here, the income taxes payable is $8,000. That's $40,000 times 20%. And so the current tax expense is going to be $8,000. But the deferred tax liability at the end of 2025 is $6,000. So that deferred tax liability added to the current tax expense is going to give us income tax expense in total for 2025 of $14,000. And as it says in this note, as indicated, the determination of income tax expense starts with income taxes payable and then adds the increase in the deferred tax liability, in this case $6,000, during the year. So, as a result, income tax expense has two components. The current tax expense, that's the amount of the income tax payable for the period, and deferred tax expense. Deferred tax expense is the change in the deferred tax liability balance from the beginning to the end of the accounting period. Chelsea records income tax expense in 2025 as follows. Income tax expense will debit for $14,000. Income taxes payable will credit for $8,000 and credit deferred tax liability of $6,000. So as indicated, Chelsea credits taxes due and payable to income taxes payable and credits the increase in deferred taxes to deferred tax liability. Chelsea then debits the sum of those two items to income tax expense. Okay, so now if we look at the continuing Chelsea example again, we find that the difference between book and tax is $10,000. That's $30,000 less $20,000. They multiply this difference by the applicable tax rate to arrive at the deferred tax liability of $2,000. That's $10,000 times 20%, which it reports at the end of 2026. Income taxes payable for 2026 is $18,000. That's $90,000 times 20%. So, what is Chelsea's income tax expense for 2026? And what is the journal entry to record income tax expense, income taxes payable, and the change in deferred tax liability in 2026? Well, Chelsea's income tax expense for 2026 will start with the current tax expense of $18,000. We will take the deferred tax liability at the end of 2026, compare it with the deferred tax liability at the beginning of 2026, and we'll find that we have a deferred tax benefit for 2026 of $4,000, which we can subtract from $18,000 to get $14,000. As indicated, the determination for income tax expense starts with income taxes payable, $18,000, and subtracts the decrease in deferred tax liability, $4,000 during the year. So then to record the tax expense, the changes in deferred tax liability and income taxes payable, will debit income tax expense for $14,000, debit deferred tax liability for $14,000, and credit income taxes payable for $18,000. That looks like a good place to stop this video. And when we return, we will look at 2026.